Good morning, everybody. Welcome to the morning meeting of the ARMR Virtual Hedge Fund. We're going to go over end of the week candles, what the macro picture looks like, risk monitor, those types of things. We're going to talk about, again, the ARMR carry trade and go over some of our trades from yesterday as we continue to harvest alpha on the brokerage firm dime. We're doing it long and short. It's the focus of our trading desk right now. And these are plays coming right out of the playbook. So we'll go over that. And I just want to share with you, a thought from a conversation I had last night. I sat down, had a very nice dinner. My cousin, haven't seen her in a while, and her husband actually, who is CEO of a technology company, private company, very interesting guy, very interesting conversation. And it's going to have major implications on the type of portfolio that we want to build coming out of this bear market. So let's go over all those things. Don't forget, you're joining a virtual hedge fund. It means you're a portfolio manager sitting down at the table. Maybe you're having a little bagel in Nova, and you're part of this morning meeting before the market opens at 9:30. What you're going to do is come out of this meeting, take this information and all the others that you might be getting from other sources, and you are going to be the smart money. You're going to figure out your strategy and you're going to execute your strategy based on risk tolerance, goals, and all that kind of stuff. Okay, you must be the smart money on your own. So the purpose of what I do here every day is to help you think it through. And then you take that information and you be the smart money. It should empower you to execute your strategy. Okay. So diving in, the last man standing is the NASDAQ 100. The 7 stocks, the Magnificent 7, who one after another are being put down, just like in the movie. This green line right here is the 200-day moving average, the exponential 200-day. This is the gray line is the standard 200-day. I'm going to rifle through all the other indexes on the ARMR risk monitor. Risk monitor has been red since right there, that red arrow right here, which is the 15th. Oh, sorry, right here. The 15th of September. Okay. Turned red again right there. Remember, we had that short trade. We actually made money on that swing trade. Got long here and got out right there. Now the market's cratered. We made money on that 1, 2, 3, 4-day rally. Okay, there's the risk monitor went red. This is the strongest index. It's the 7 names. But let's just rifle through now. Look at the NASDAQ 100, which is sitting on the 200-day exponential. It's going to gap up 1% today, so it's going to try to hold this green line. The last line of defense would be the gray line, which is the standard 200-day. Now look at the Dow. Already cratered below both of those green and gray lines, and you're about to see the 50-day, which is black, cross below the 200-day, and we all know that's called the death cross. Now, the reason I'm going over this with you is on the 15th of September, we told you, hey, risk monitor red, something's wrong with the market, protect capital. Well, the market's down something like whatever it is. I don't know, 7-8% off the high. I don't know what the exact number is. And what I always find ridiculous is that traditional financial TV, traditional financial analysts that generally accepted market principles. That's a little inside joke for accountants. Okay. They won't call it a bear market till it's down 20% off the high. And I always I find that ridiculous. How does that help anybody? How does that help any investor to lie and lie and lie about the market decline until it's down so much that you have to say, okay, now it's a bear market. It's down 20%. I mean, by the time they call it a bear market, the risk monitor is going to start going green and we're going to start putting money back to work in all likelihood. I mean, every now and then the market crashes and goes down 40, 50%, but that's a rarity. So, 15 to 20% off the high is pretty much the move. And by the time they come out and tell you, now it's a bear market, what good is that? And we'll be out there probably, I don't know, probably, depending on what the algos tell us, we'll be buying the market. So the algos are, I just find it so ridiculous. The point of this call right now, okay, in case you didn't already hear me on the 15th of September, and then again on the 13th of October, after that 4-day rally, we are in a bear market. We're in the teeth of a bear market. Okay. How do we know this? Here's, other than all the reasons, we're going to look at charts in a minute and you can just see it. But many things anecdotally are happening. Doesn't make a difference what the earnings announcements are. Good news, they sell the news. Bad news, they kill the stock. Okay. That's a bear market. Remember 2020 when the market was ripping higher? Any piece of good news, the stock would be up 30% on earnings. But that's gone, right? So we're in a bear market. Good news comes out, stocks sell. They're up for a day and then they sell off, or they just sell off on the good news. And God forbid you miss the number. I think end phase today is down another 20%, right? I mean, I chuckle at solar and wind. It's such a joke. It's such a life imitates art. And I just, it just feels so much like, we're watching Don Quixote play out. You know what I mean? Anyway, I digress. So anecdotal things are happening, like reaction to earnings. Or for us on our trading desk, we're making as much money, if not more, short during the day than we are long. So we're making money long and short. And we only make money long and short in bear markets. Like last year, we call it the flip trade. We get long, either book a profit, get stopped out, boom, flip short, make money on the short side, go long again in the afternoon. That's the third thing I would say. Not only are we making money day trading short, but we're getting 2 or 3 trades a day. That only happens in a bear market because volatility is expanded. So you get sell-offs and rallies during the day. You can make money long and short during the day. Risk monitor green, uptrends, volatility compresses. There's only 1 trade a day. Right out of the playbook, we get a trade, we get long, we make some money on the long trade, get stopped out, trade's over. And there's not that sell-off that you can then short, which then sets up a rally in the end. So there could be 3 trades in a bear market. In a bull market, there's just 1. Okay. So there's not only do we see it factually, we can look at the Dow and we know what's happening, but also anecdotally, we can see the type of market that we're in, and we're in the teeth of a bear market. Okay. So anyway, the Dow looks like to be in jeopardy of the death cross. Small caps have been leading the decline. Death cross happened here, which is when the 50 goes below the 200. So that was right here. All right. So that was the beginning of the end for small caps, and they've just imploded. Right. And now here's another death cross, which is the equally weighted. I told you guys about this a while ago, right? Right there. The 50 crosses the 200 and the market equally weighted is just getting crushed. Okay. Here's the equally weighted NASDAQ 100. The equally weighted NASDAQ 100 is getting killed, already below all the key moving averages. Then you go to the weighted. And so I'm saying to you, okay, the weighted is the last man standing, still above the 200. It's sitting right on. It's going to be up a little bit this morning. Okay. But looking at all the signs and the way they're treating even stocks that, had a good earnings number. There's Microsoft with a great earnings number, gap up and got crushed. So we're in the teeth of a bear market. And we're going to use algorithms to tell us when to start getting long again. Okay. The NASDAQ, if it breaks below here, really the last line of defense is this standard 200-day moving average of 338.95. Call it 339, somewhere around there. 339. The green line here is around 345.5. Okay. Somewhere in there. You break that level and things are just going to get real ugly. And before I wrap up this thought, do you remember what we talked about a few weeks ago? Okay, when the risk monitor originally went red, I shared with you the MACD chart This is just a simple MACD. You could use any indicator you want, okay? I don't care what indicator you want to use. MACD is just a favorite of mine, but any momentum indicator, right? When the blue line starts to separate from the black line, breaking down like this, the fast is going down faster than the slow is basically the simple way to put it in layman's terms, right? Okay, that's the beginning of a really nasty weekly move lower. Remember we talked about that here, and that weekly move is playing out, and it's starting to fall off a cliff. Remember we talked about it here too in the S&P. You can highlight it right here. It starts to separate. That's when it gets ugly. So the little crosses, it could wiggle. See how it wiggles in here and it's not really separate. Okay. But when it starts to really separate, that's when it gets ugly. And you can look at a histogram for that. I don't know if you can see this down here, but the histogram down here is getting worse and worse, telling you the differential here is getting bigger and bigger. Okay. So, bottom line, that means what we're doing here on our desk is a focus on the ARMR carry trade. I don't have a single highlighted group to talk to you about today. I've been talking about oil, uranium, crypto, precious metals. I intentionally left it blank today in the captain's log because I want to just reiterate that now is a time to protect capital. It's not a time to start planting seeds and hoping you can make investments because it's just not a time for that. If you look back over the last couple of weeks, I challenge you to find anything in your portfolio. Eras, don't say shipping. Eras has been on shipping and those stocks are going up. But I challenge you, other than shipping, to tell me what stocks in the portfolio are getting away from you, that are running away. Right? Crypto looked like they were going up. We made money on crypto, coming back down. Uranium stocks tried to break out, can't go anywhere. Any technology stock, forget it, they're getting killed. Precious metal stocks. I sold my GDX. Metals mining stocks can't go up. Even energy stocks are struggling to go up. It's a bear market. And so I left it blank. There's not even a highlighted group because I got no interest in putting money to work in an individual stock right now. The 100% focus of this trading desk is on the ARMR carry trade. And we're just crushing it this week. We had a big Monday and an even bigger day yesterday. And part of when I say crushing it, a major part of that is how much money are we making versus the risk we're taking. So if I go put a lot of money in a meme stock, there could be huge upside and I can also get wiped out. Okay. So a huge trade on an individual stock where you're taking massive risk for the reward compared to a huge trade on an index where you have no individual stock risk and the average holding period is about an hour. Do you see what I'm saying? You have to compare apples to apples. You can't forget about the risk aspect of a trade and only look at the reward aspect. When it comes to the carry trade, let me just go over it again real quick. 100% of the portfolio owns treasury bills. We're collecting 5.5% out till March, and then we'll roll it again. Hey, Fed says that rates are going to be higher for longer. Sounds good to me. We'll just keep rolling to whatever the highest rate is on the curve over a 12-month period. And by the way, if I was doing it today, that's moved to April already. Okay. But I've already put in the position with a 5.5% yield. I'm just going to let it sit there till I get to March, and then I'll roll it. You can't you can't just hold money markets. Money markets don't pay interest. I should say that differently. They only pay interest on settled cash. So if you're day trading, cash never settles, brokerage firm never pays you interest. Okay. So you have to actually buy the treasury bills. The carry part of this, the fun part of this, so I'm carrying treasury bills. The fun part of this is the brokerage firm will give me 100% margin on those treasury bills. I can borrow money during the day and not pay interest, right? You don't pay margin interest unless you hold it overnight. So I'm getting capital to trade free. There is risk in the carry trade. It's just the risk I'm willing to take. I'm willing to take market risk. I'm trading triple the indexes. That's a lot of risk. Let's be clear on that. If I'm long a position, God forbid a bomb goes off somewhere, market craters probably going to blow right through my stop. I'm going to have a big day. That's a risk. But that's, of course, a risk in any portfolio that anyone is structuring. So I put that over here. That one-time craziness is true no matter what you're doing, unless you're just holding treasury bills. Okay? So I'm going to put that over here. I'm willing to take that risk. Anybody has to take that market risk. When they put money in the market, something crazy could happen. But I try to mitigate that risk. Our average holding time is like an hour on a trade. So when the reward is worth the risk, that's when I want to put my capital to work. I'm going to trade triple because I want to get paid on that. The equation is right. The reward is worth the risk. My holding period is going to be as fast as possible. Bang, bang, bang. Get out of the trade. Done for the day. Thanks for playing. That's the carry trade. And it's the smart trade. We smart trade. We don't day trade. There's been a day. I think there's one day today we didn't trade at all. It was a 100% down day. I shared that with you a couple of days. I said there was just no trade. The market was god awful, and it's in the playbook. When the market drops more than 1% in the morning, chances are it's 100% down day, and that's what happened. So we didn't trade at all. We have no overnight risk. I don't care what futures are doing in the middle of the night. It's the greatest feeling on earth. I don't care what the market. I come in this morning, market gaps up. I don't care. We have gap and go plays in the playbook. We have gap down plays in the playbook. We have flat open plays in the playbook. It's just that simple. We get the plays in the morning. We put the money to work. If we don't get a play, we don't put the money to work. The whole time we're just collecting interest. Okay? So that's the focus of our trading desk. And the trade we had yesterday looks like this. Whoops. That's not what I wanted to do. Okay, it looks like this. Market gapped down and went down. We actually made money on that rally right here, which is, if I do say so myself, amazing. Okay, because then the market cratered. And the only reason why we made money on that rally is our stop discipline. And I want to remind everybody who's trading with me, doing the ARMR carry trade, the stop discipline works. Yesterday is a perfect example of it. If the stops that we elevate get hit, there's something wrong with the trade. It's over. Forget about it. It's not our trade. You have to get out of your head, what happens if the stop gets hit on a tail and then it goes up? I don't care. First of all, it happens infrequently. Every now and then it happens. So what? I made a little bit of money instead of a lot. So what? The key to the carry trade is reward to risk, right? Which is what I just talked about. When the stop gets hit, the risk is too large. I don't want my money at risk. That's why we follow the stop progression we do. When we get paid, the stops don't get hit. And I'll show you what I mean. Okay. So we got on a trade here, we raised the stop quickly. It got hit. Trade was over. Market cratered. Okay. I'll get to the short selling in a minute, but let's just talk about the carry trade where we don't short sell. All we're doing is looking to pick up alpha long, triple the indexes. Okay. So the market craters and we wait. It comes right down to a key location. It's one of our favorite places, okay, to put on a trade. See this, if you could see the light blue line, the cyan line, that's the ARMR ATR low of the day. This is right in the playbook. The ATR low of the day is a favorite location to begin a long trade. So you could see Market was down all day. All you got to do is draw the downtrend. It's not hard. It's pretty obvious. When it breaks the downtrend and goes above the first standard deviation below the VWAP, which is the black dot, that's the green box. That's where we put the money to work. Market ripped higher. I think that was like one. What was that one? I think I cut off the time. What time was that? I think it was 1:45. Okay. From 1:45 to 3 o'clock. The whole trade was over. From 1:45 to 3 o'clock. The stops never got hit. We booked a little profit at the VWAP. We always do. And we booked profit right at the high of the day. Look, I'm doing this live with you as it's happening. So you're witnessing this happen. When it hits that target, we book some profits. And it turned out to be the high of the day. And we raise our stop aggressively at that point. So we booked some profits at the high of the day. I mean, not the day, the high of that trade. And then we got stopped out the next bar. We'd made all our money. Market cratered to the close. And we captured the alpha. That's a classic ARMR PM trade, afternoon trade. And it's right in the playbook. And we're going to look to do that again today. I don't know if it's a PM trade. I don't know if it's going to be a gap and go day. Hey, the market could gap and go today. People could, made a lot of money short this week. They might turn around and sell their puts all the way to the close and the market skyrockets. Okay. I'll be happy to put on a gap and go trade. Let me finish up this conversation because I got to get to the live desk and set it up. So let's shift gears for a minute now and finish up the conversation with I feel like I'm missing something I wanted to say. Oh, yeah. So the short side, for those of you who want to short with us, sometimes what we do and what we did yesterday is when an early morning trade hits a stop quickly. So we got long yesterday. I'll just show you this one more time. We got long yesterday early in the morning here, okay? And when that hit the stop and started to break down, that was the time to flip trade. So for more aggressive portfolios, I don't do this in the ARMR carry trade portfolio, but I have another portfolio I call the ARMR macro fund, and that's where I'll flip trade. And so we went long, and I bought the puts on the NASDAQ, the Dow, and the small cap index, made money on that sell-off. Okay, so you can flip trade short in a bear market, and that's been working. All right, let's wrap up with just one thought here. I had a really interesting dinner last night with a friend, my cousin's husband, CEO of a private software company, technology company. And he's being, recruited to run a different private company, and they're, with the intention of going from, I don't know, what do you say, like I think he said like $500 million in sales up to $1.5 billion, and then sell the company. So there's a whole exit strategy. It's a really interesting conversation about how a CEO and how private equity looks at an investing opportunity. It was an interesting conversation. But out of the conversation, here's a guy who's not trading stocks every day and not involved in all the hype around AI and whatnot. We talked a lot about cybersecurity and stuff because he's been directly involved in 2 cyber attacks on his company. He's the CEO, so he's got to deal with that stuff. So it was a really interesting conversation. So this comment I have for all of you investors out there. I want to remind you, if you go to the ARMR website, you can see the whiteboard, and you're going to say, gee, Brett hasn't changed the whiteboard at all recently, and it's all AI stocks. And the conversation I had last night just reiterated why I'm not changing the whiteboard, and I want to invest in all AI stocks. I'm not going to go through the details of our conversation, but suffice it to say, AI is dramatically changing the way businesses operate, and the right businesses are going to become very profitable with it. Margins are going to skyrocket for the right businesses. And so what we invest we hear all the hype, it gets overhyped, the stocks break down, and the average investor walks away from the idea, oh, the stocks broke down, forget it, I'll look for the next sexy idea. It's out of those ashes of the breakdown that will come the best investment opportunities that will lead to huge upside in the right market. And without a doubt, the ARMR Special Situations Fund, when the risk monitor goes green and the markets start heading higher again, it's going to be loaded to the gills with AI stocks. It's going to be loaded to the gills with companies that benefit from AI. So don't let the weakness in the stocks and the talking chuckleheads on CNBC make you think that that investment opportunity is dead. Don't do that. That's a mistake. What's happening right now, it's like the internet stocks 2000, leading up to 2000, they went berserk and then they all got destroyed. And I remember 2001 and now the internet's dead. And of course, it led to some of the greatest investments of all time. So this bear market is a beautiful thing. I hope it gets a lot worse. And then it's going to set up an investing opportunity of a generation in the right AI stocks. And you and I are going to be on it. I can't wait to work with you guys. Live desk starts at 9:30. Let's wrap up this week. Thanks for all the time you spend with me. I appreciate it. And I'll see you guys on the desk. And remember, take all the information around you, set up a strategy, and be the smart money. Have a great trading day, guys.